Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
Welcome everybody to today's Take Back Control Tuesday. We're pumped for you all to be here. I want today to be our best webinar we've ever done. Best Take Back Control Tuesday. I want to get the most action, the most comments. I want to have a ton of communication throughout this whole presentation. So I first off want to see of you guys here, how many of you guys, is this your first time being a part of Chris Naugle's community, watching the Infinite Banking presentation? Let's see. I know we got Tess. She's been here forever. She's probably been around this campfire longer than I have. I love it. We got a couple of new people in here. I love it. And I saw some of you guys saying this is your first time being able to join a live meeting. I highly recommend coming to every live meeting that you possibly can, because it's much better than being on a recording on YouTube, because you don't get the same feel. And being on a webinar like this, you're able to chat in here, ask your questions, be a part of the presentation, so we can contribute and make sure what we're talking about can relate exactly to you and what your questions are about and what you want to hear. So the more you're going to get out of it. And you guys are spending your Tuesday afternoon with us. So you're taking time out of your guys' day to be here. I want you guys to get the most out of this as you possibly can. And the way for you guys to get the most out of this is for you guys to contribute. So I want to see exclamation points, emojis, capital letters in the chat. Give me everything you guys got, because the more enthusiasm you guys have with us, the more you're going to get out of this too. So I'm excited to share with you guys today, and I hope this can really, hopefully change your guys' financial future. But we're going to talk about a few different concepts today, and let me share my screen and we can begin. All right, well, today we're going to be cutting through some of the financial noise that's going on in America right now. We're going to be talking about I'll ask you guys, who of you want to have more money? Who wants to have more money for just about anything in their life? Whether that's to go and go on more vacations, to have time to spend with your family, to start a business. Obviously everyone wants more money, right? Who wants to be financially independent? Me, I love it. Thanks for contributing, guys. Let's see those exclamation points, the emojis. Let's see the enthusiasm. Everybody does, right, Chris? So who wants to be creating generational wealth? Don't we all, right? So there's this little known fact about the wealthiest families in America. They've been using strategies to build wealth, things that we're not taught to do in our normal, schooling and education of finances. So today we're going to dive into some of those strategies, and this main concept, the money multiplier method, is what we call it. So how can you guys become the bank? Why would you want to become the bank? Well, there's a few different things I want to talk about with all of this, but if you guys can just keep these questions in the back of your mind throughout this whole presentation, that's the goal. So for the first little bit of this presentation, I want to dismantle everything you guys think you know about money, because it's going to take some time for your mind to shift. So we're going to break you down and then build you right back up the right way. And so that's because until you understand, until we can see what we're not seeing right now, what I'll tell you won't make sense. So the first concept here is control. Before we get into this, control is a massive concept that needs to be understood. Control is one of those things in life that if we're not aware of it, someone else is going to control it for us. So there's three things I look at that we want to have control over in our lives. The first being time. Time is that one resource that once it's gone, it's not coming back. So that's the one most valuable asset that we want to control in our lives. Two is our mindset, our mind, because that's the one thing that we actually can control every bit of it. And if we're not going to control our mind, someone else will. The last one's money. Money is something we all want to control. So when we're looking at these three concepts, well, which one do you want to address first? If you're trying to change something in your life, is it time? Is it your money? Is it your mindset? Well, in my opinion, I would say it's your mind. Because if you don't control or can't control your mind, then you can't control money. And if you can't control money, you can't control time. So as we go through this presentation, we're going to talk about controlling our mindset around money. So that when we do talk about becoming our own bank and infinite banking and all these things, it makes a lot more sense. So as we get into this strategy we're talking about is a 200-year-old system. It's probably the most powerful way of saving, creating, preserving wealth than anything else. And it doesn't require you to work any harder, any longer, or change anything except where your money goes first and how you actually view money and view banking. You guys here on this presentation are what I call the 5%. You guys are taking time out of your Tuesday to learn about these different financial strategies. If I was to go around and ask 100 18-year-olds and ask them, well, when you guys are 65, when you're ready for retirement, will you be successful? What do you think they're all going to say? They're all going to say, of course I will. No doubt in my mind I'll be successful. But something happens, something changes from when you're 18 to 65. That changes the whole dynamic. Did you guys know that 5 out of 100 people will be financially secure at retirement age? And that's not even successful, rich, wealthy. This is just secure. And think about that. We live in America, the land of opportunity, this great country we live in. And how many would you guys think that that's wrong? That means 95% of people in America are going to be working until they're 65, 75, or 85, taking on 2 jobs, not because they want to, but because they have to. So I want you guys to understand that you are not a part of that 95%. You being here are taking the first step to be a part of the 5%, no matter your age. And the biggest difference between you and us and them is your willingness to invest your time and money and effort to learning something new. So let's talk about why people aren't successful and some of the mysteries that come with money. Well, there's a lot of things. I would say the main 2 things are a part of these 2 categories. There are some wealth killers out there, and there are some mindset problems that people have. Wealth killers, meaning, well, hey, you work hard for your income. And when that income comes in, a portion is taken out for taxes. Then whatever's left over is going to go up and down with volatility and inflation. Just right there, it's very difficult to build wealth for most people. Then from there, it becomes even more difficult when we follow the status quo. When we follow and we're the sheep to what we're told to do. And then, of course, fear comes in. We're not going to try new things, risk money, start a business because of fear. And life always gets in the way of things. You know, for example, COVID. COVID was not something anyone expected, and it hurt a lot of families. And so those things you can't prepare for. But if you can build the right foundation so that all of these mysteries of money don't affect you, that's what we're trying to build, just like these wealthy families throughout American history have. There's this one of my favorite quotes I want to start with today is by Will Rogers. He says, the problem in America isn't so much what people don't know. It's what people think they know that just ain't so. Think about that. A lot of what we've been taught about money may not actually be the truth. So I need you guys to keep an open mind throughout this webinar because I'm going to challenge the way you think about money. Have you guys ever seen this YouTube video? It's called the backwards bicycle. You can look this experiment up on YouTube. Well, you know, when you're a little kid and you learn how to ride a bike and, you know, you obviously pedal and the bike goes forward, you turn the handlebars right, it goes right, you turn the handlebars left and it goes left, right? Very simple. Well, this guy wanted to test out if he turned the handlebars around, could he ride the backwards bicycle or the bike backwards? So he did that. He turned it backwards He got up on the bike. He's recording himself do this entire thing. He takes a few pedals and he immediately falls to the ground. It's really funny if you guys actually watch it. But he does that over and over again for hours. And eventually he figures it out. But then he tries to go back to riding a bike the normal way, and he couldn't. He literally could not ride a bike, even though he was taught as a little kid how to ride a bike. He got on, fell immediately, over and over and over again until he could figure it out. Well, I say all of this because when you learn something one way, it's very hard to change. And the same is true for money. Since we were little, we've been trained how to think about money, just like we've been trained how to ride a bike, and it's in our brain, it's muscle memory. What would happen if I told you what we were taught was wrong? It'd be very difficult to change to the new way of thinking. But it wouldn't be impossible because eventually you would learn, just like this guy, how to ride the backwards bicycle. You know, I mentioned this is a 200-year-old strategy, a strategy that I didn't invent, Chris Naugle or our team didn't make up. This is something that's been around for a long time, and a lot of other people talk about this. For example, a lot of you probably know Robert Kiyosaki. In his book, Second Chance, he talks all about this strategy. If you look at this next book here, we got Mr. Tony Robbins, Money Master the Game. In section 5.2, he discusses this topic in depth. If you read this book, Becoming Your Own Banker by R. Nelson Nash, he is the founder, the godfather, the one who coined the name infinite banking. This book will teach you everything you need to know about the concept. And these two books here at the bottom are by my mentor, Chris. A lot of you guys know him. He talks about this strategy and teaches it in a new way. So just so you guys understand a little bit about me and who I am as well, a lot of you guys, it's your first time on here. My name is Carson Herline, and this is my wife, Anna. We live in Southern California. We love to be outdoors. We love to surf. We love to travel around the world. And we do a lot of fun things. But about 3 years ago, I became my own bank. And this has allowed me to buy over $5 million worth of real estate and has given me the perfect foundation to build generational wealth. And my story is very simple. I'm sure most of you can relate to it too. In my early years, I made a lot of mistakes, as young people do, but I did do one thing right. At 18 years old, I went on a service trip where I lived abroad and served people for a year. And when I came home, and I was in college, I had a lot of outside influences pushing me different directions. And in one hand, I had the traditional schooling mindset. All my friends, peers, teachers were teaching me, math, English, economics, and really how to be good at doing tasks. I had that in one hand. And on the other hand, I held real estate investing, entrepreneurship, freedom, and control. And I came to a point where I had to decide, they were pulling against each other. Do I want to work for money, part of the rat race, or do I want to learn how to make money work for me? And it was that tension that brought me to a point of decision. And that decision to drop out of school and pursue a bigger game, the wealth game, has brought me extreme happiness and success already. And I'm early in my journey, so I'm hoping to share with you guys what I've been so fortunate to learn already. So when we talk about the different mysteries of money, there's a lot of ways we can go about all of this. First question I would ask you when it comes to money is, what's the definition of money? Now let's revamp the chat, guys. What do you guys think? What are the definitions of money? I've heard all kinds of answers in the past, but what do you guys think? I've seen, what have I seen? I've seen fiat, means of exchange. That's great. I've seen currency. People talk about Bitcoin. What's the definition of money? What is it really? Well, in my opinion, the definition of money is just a means of exchange. Money for food, food for money, right? Every day. Money for a car, car for money. Money for house, house for money. Nothing more than just a means of exchange. So then if I were to ask you guys, well, what about compound interest? What companies use compound interest? What would you say? Well, most of you would probably say banks or Wall Street, but the answer is not one business uses compound interest. But let's focus on banks because that's usually the most common answer. Banks don't make compound interest, but they charge you compound interest, but they don't actually use it themselves. For example, if you wrote your name on a $20 bill, walked into your bank, gave it to the teller, he walked in the back, do you think he's going to go put it in a box with your name on it and let it sit there? No, obviously he puts that money to motion immediately. It gets lent out to someone else. There isn't a business in the world that uses compound interest, nor do banks. Banks keep money in motion just like you should have been shown to do. But you weren't. We've been taught to park money and leave it in someone else's control. But today that's going to change, because if I was to ask you one question, are dollars worth more today or in the future, what would you say? You'd probably tell me, well, the dollar is worth more today. And I hope that would be true. I mean, if you think about how many candy bars you could buy with $1 20 years ago compared to today, it's obviously much different. What about taxes? Are taxes going to go up or are they going to go down? Well, would it be better to pay tax on the seed or on the harvest? Taxes will always go up. And if they don't, they'll just find more crap to tax us on. And wouldn't it make more sense to pay tax on the seed and not this big harvest you've built? However, most of us don't practice that. We don't preach that because most of us probably have a 401k plan or some employer-sponsored plan. And what we're actually doing is when you give those dollars to the 401k, you're giving up today's dollar in exchange for weaker dollars in the future. You're actually compounding the tax against yourself because the tax is always going to be there. And when you pay the tax on that money someday later, you're going to pay tax on a larger amount. You won't pay tax on the seed, but you'd rather pay tax on the harvest. You're going to pay tax on the dollars. You could pay tax on the dollars today and not on the future higher dollars. And this is funny because we've been taught, again, to give up control. We literally do things with money, and we've been taught to do things with money that we would never do with things that money buys. For example, if I was to go to the local grocery store, go buy a loaf of bread, drive home, open up the freezer, throw my loaf of bread in the freezer. Do you think I'm going to let it sit there for 5, 10, 20 years, come back, open up the freezer, take out the bread and say, I'm ready to eat this now? No, you would never do that with a loaf of bread. Now, what if I told you, well, let's go down to the store, the local Ford dealership right now. Let's go buy a car. Let's go buy a truck. Drive it home. We're all pumped about a brand new car. We leave it in the driveway. And then we wait 5, 10, 20 years to drive that car. We would never do that. But that's exactly what we've been taught to do with our money. So if you want to be good with money, then you need to start changing who's in control of it. So when I ask people about their retirement accounts, they usually know very little. They're either going to know if they're in a high or low risk tolerance, or they're going to know if their statement went up or down in the last quarter. It's probably it. And we've been taught to just accept that that's the way to treat and use our retirement dollars. So obviously there are better ways to do these things. So let me ask you guys a question. And again, let's open up the chat. Give me some energy here. What do you guys think? Can you make money earning 4% while paying 6%? Is that even possible? Do those numbers make sense? Well, indeed it is. It's true. You can make more money earning 4% than paying 6%. Let's say, for example, you wanted to go buy a car. Let's say you had $25,000 sitting in your local bank and you're making 4% on your bank account. Let's say you have an amazing savings account. They're paying you 4%. I guess that is kind of common nowadays, but it'll probably go away soon. Let's say you make 4% though, and you're pumped about it. You leave your 25 grand at the bank. You walk into your bank and say, hey, I'd like to take my $25,000 out of my savings account and go buy a car down the street. I want to buy the car cash. Well, the bank's going to say, hold up, leave your 25 grand here. It's making a good return. How about we give you a loan for $25,000 and you go get the car like that? We'll charge you 6% on the loan. And the bank's going to say, and you will actually make more on that 4% account than while you're paying us 6% on the car loan. Those numbers don't add up to most people. It doesn't really make sense. But let's actually look at that math and see if that's possible. See if the banker's telling the truth. Well, a 60-month car loan, 5 years at 6%, your payment would be $483 a month. For 60 months, you'd end up paying $28,999. While that's happening, your $25,000 sitting in the bank making 4%, by the end of 60 months, would be worth $30,525. So why is that the case? Well, there's different types of interest. There's something called simple interest and compound interest. If you have interest that you're slowly paying down, it's depreciating every month, it's always going down. But if you have interest that's compounding on itself, it's always going up. So eventually it's going to exceed it. So if you look here in this example, the banker was right. You would have made an extra $1,500 in that 5-year span by just buying the car a different route, getting a loan and leaving your $25K sitting at the bank. So now that we've kind of talked about some of the mindset behind this, let's talk about the money multiplier method. Comes in 3 ways. Well, not 3 ways, but there's 3 things that are involved here. One is the machine. This is the machine we use to get this system to all work for us. We need something there that controls it all. And then the fact that this is a marathon. This concept is not a get-rich-quick scheme. It takes a long time to build, and it's about building wealth as a marathon, not as a sprint. And then the millionaire, meaning your goal can be whatever you want. If that's time freedom, that's building a business, if that's retiring early, being multimillionaire, whatever your goal is a massive part of how this method's structured. So what is the machine? Well, the machine is none other than a dividend paying whole life insurance policy with a mutual company. Now, some people will look at this and say, what the heck does whole life insurance have to do with building wealth? I thought whole life insurance was a scam. That's what Dave Ramsey said. That's what Susie Orman said. It's a scam. Don't buy it, get term. Well, this is what the rich do. And that's what they don't tell us to do. If you want to know actually who does this, let's give you some examples. Top left here on the screen is Mr. Rockefeller. John Rockefeller built probably the wealthiest family, biggest empire in American history. And he did it with this concept, with whole life insurance. This top right guy up here, Walt Disney, he started Disneyland with his whole life insurance policy. These bottom two guys, the billionaires of today's world, Warren Buffett, it's reported that billionaires have over $1.2 billion in life insurance. And how about politicians? What about Biden or Trump on here? No matter the side you're on, both of them utilize the strategy and both of them are wealthy. When Biden became president 4 years ago, his financial statements came out. And if you look at his financial statement, he actually had 4 whole life insurance policies on his balance statement. And you know what's crazy about all this is the wealthiest people that do this. But you want to know who's the number one purchaser of whole life insurance in the world? It's actually banks. If you look up BOLI, bank-owned life insurance, they own the most amount of life insurance. They own more life insurance than land and buildings combined. Why? Is it because they're stupid, or is it because they know something the rest of us don't know? Obviously, they know something the rest of us don't know. And again, the concept's been around for a long time. Whole life insurance has been around for over 200 years. Before the tax code was even invented in 1913, people were doing this. So banks keep their money in life insurance. Actually, it's reported that there's over $185 billion of whole life insurance within the largest banks in the country. So how do banks actually operate? Well, let's say you have $100,000. And you leave it at your conventional bank, making 4% again. You have a great bank. You're stoked about it. When you deposit that 100 grand with the bank, what are they going to do? Obviously, they're going to lend it right back out. So let's say they go to your neighbor down the street and they're going to give your neighbor a mortgage, a home loan at 7%. What's the guy going to do when he closes on the house? Well, it's going to pay the seller. And where's the seller going to put his money? Back in the bank. Then what's the bank going to do with the money? Well, he's going to lend it out again. He's going to go to your other neighbor down the street who wants a car loan. He wants a brand new BMW. He'll give him an 8% car loan. Where's that money going to go? To the car dealership. And where are they going to put the funds? Back in the bank, which they can lend out on another loan, a home remodel, for example, at 9%. Who's then going to pay the contractor? And then the contractor is going to put the money where? Back in the bank. Same with the debt consolidation loan. The bank can then lend the money out again to someone else who needs to pay off their debt, pay off their credit cards, and then the credit card companies are going to put the money back in the bank. So who's in control of all of these transactions? Who has the least amount of risk in all of these transactions? The bank. While you're making 4, they're making 7. While you're making 4, they're making 8. They're making 4% more than you. While you're making 4, they're making 9. While you're in 4, they're making 12. If you add all those together, they're going to make 20% more than you over that time period, over that year of you just leaving your money there. So how much more is the bank making on your money compared to what they're making on it? Well, if you think, well, they're making 20, you're making 4, they're making 16% more than you, right? Well, actually, that's not the truth. 4 goes into 20 5 times. So they made 5 times more than you. They made 500% more than you did. They made 500% on your money because we were taught to give up control of our money. So welcome to what banks really do. It's actually reported that banks make between 400 and 1,300% on the money you leave there. If you go to BauerFinancial.com and pull up any bank you want and get their annual reports, you can see everything. There isn't a bank that makes less than 400% on your money annually. If you guys go to any main downtown corner or big part of the city in any town or country or city in America, who's going to have the nicest properties on the main street downtown? The banks will. Always. Every bank. It's because we're paying for it. So earlier when I told you these banks are the number one purchaser of these specially designed whole life policies, the thing I said was, are the banks stupid or do they know something we don't? You now should probably know they know something that we don't. They're very smart. And let's talk about statistics. Now that you know how the banks manage their money, how do Americans manage their money? Well, here's the actual annual pattern of spending for Americans. Usually about 30 cents of every, or sorry, 20 cents of every dollar made in the household goes to automobiles, car payments, gas, upkeep, all that good stuff. Around 30% of our income goes to housing, mortgage payments, insurances, all that kind of stuff. Usually 40% of our income goes to everything else, entertainment, travel, food, all that good stuff. That leaves us 10% to save. And actually, as of this year, that rate is closer to 5%. So we're only saving a very small portion of our income. Now, when financial advisors talk to you about money, they're usually talking to you about the money you save and how you can make more money and build a retirement on that money you save. But usually, if you're investing, the more risk you take, well, the higher return you're supposed to get, the more risk you're taking. So what if you can't save more and you don't want to take any more risk? What options do you have to build something? How much more risk do you really want to take? Well, think about it. I mean, today, I don't want to talk to you guys about how much you're saving. I'd rather talk to you about how much you're spending, because I'd rather take some of the money you're spending and show you how to build wealth by simply taking back control of the money you're giving away. So if you want to build wealth, look at where all your money goes and let's find a way to take back control of that. So let's show you that example. If we are saving 10%, great. 20% goes to automobiles. Well, how much of your automobile payment is going to interest? Usually it's around 5 cents of the 20 cents. So if we were to exchange that, now instead of paying someone else interest, we now save that 5 cents of every dollar we make going to car interest and save that for ourselves. We just increased our savings from 10 cents to 15 cents. We just upped our savings by 50%. Now, what about a home? I bet you can guess a lot of that goes to interest. Usually about 25 cents of that 30 cents goes to interest. And houses are funny. I mean, we all talk about owning a house. We all want a mortgage, right? Well, look at how much of your payment actually goes to interest. Your interest rate might be 2%, 3%, 5%, and you're stoked because you got a good rate, right? Well, who cares what the rate is? I bet over 80% of it's going to interest, no matter what payment or what interest rate you got, because all that interest is front loaded in the first 7 years. And then you're going to move in 7 years because you want a new house, because you want to upgrade or downgrade. And then you restart the loan cycle, or you'll refinance in the same thing. You'll restart it. All the interest is being paid up front. So we get hung up on the rate. It's not about the rate. It's about the volume of interest you're actually paying. So let's keep going with that example. Let's look at everything else. Usually everything else, around 5 cents of that goes to interest. So now look, if we're able to not pay other people and just redirect where our money is going, start to save more of our funds we're otherwise paying to other people, look at how much we're actually able to save of our income, close to 50%. Now that is a huge game changer to people building wealth. So I'm going to show you guys now how to get back the money for every truck or car you ever buy, drive, and own. Now let's get to the machine, right? This policy. Well, there's a few things I want to talk about with this policy because there's a lot of questions about it. Don't get focused on these numbers right here quite yet. I'm going to get to them in a second. But premium. We have to change our mindset around life insurance premium, because usually like health insurance premium, all kinds of other premiums, we think it's a payment, a cost. And most cases it is. So you're not wrong. But when we build this policy that's specially designed, your premium for the policy looks more like a deposit into your bank than it looks like a actual payment. It's a deposit, because think about it. When you go and deposit money in your bank, you can go and take that money right back out. It's liquid. And I've never met someone that doesn't want to put or deposit more money in their bank account. So if your policy is structured correctly, it's exactly that. It's a deposit, because you can immediately use it. So we need to start changing the way we think about premium with life insurance and how we build these type of policies, because it's going to look more like a deposit than a premium. Then a lot of people say to us, well, hey, age is very important. I'm in my 50s, 60s, 70s, and I don't think I can do this because my life insurance premium is going to be too high. Well, it's not necessarily the case. When we're building a policy like this, we can structure it however you want. And we're building it where the death benefit is the lowest part and we have the most cash value possible. If I say, hey, insurance company, I want to do $1,000 a month premium, but the person is 18 or they're 65, the premium is the exact same. I told them the premium I want. I told them how much cash value we want to have access to. Your death benefit might be much lower if you're older, but it's not going to affect the cash value or the premium. So if you're older, age doesn't matter. And same with the death benefit. It's important to understand you have the death benefit, but we're not building this policy for a death benefit. We're building this for cash value control and being able to become the bank. So the death benefit is not as important. when we're building a policy like this, at least. So like I said, we're going to talk about how to get money back for every car you ever buy, drive, and own. So let's give you some real examples. Let's take a look at this policy we were just looking at. Well, if you were to put $10,000 a year into this policy, this is just an example we have. This is one of our clients. He put 10 grand a year into it for the first 7 years. Now this premium, 10 grand a year, this can be whatever you want. This can be $300 a month. This could be $1 million a year. You have complete control over how much premium you want to do, and it depends on your situation. For this specific example, it's 10 grand a year. And if you look at the cash value on the right side here, the cash value shows 5 grand, about 6 grand in year 1, which means the cash value is how much money he has access to use right away. So that's how much he has in year 1. Year 2, he has access to about $12,000 liquid. Year 3, it shows 4. It's a drop. That's because I want to show you guys how to take out a loan from this cash value to go buy a car, which is what we're going to do. Whenever we take cash value out of the policy, it is a loan against our premium deposits. We're not touching our premium deposits. They are always sitting with the company, earning interest and dividends while we loan against it, paying money in and out of that. So for this example, we're going to say we take $25,000 out for a car loan and we go buy a car cash. So your cash value drops to just 4 grand because you took money out, obviously, and you go buy a car cash. Now, what are you going to do? Well, if you're going to go get a car loan at the bank, you're going to pay them monthly every single month, almost $500 a month. If you're going to buy a car cash regularly, you would now spend 25 grand and then try and save up money again, refill your savings account so you can buy something else 5 years down the line or whenever it is. So instead of paying someone else interest monthly or refilling our savings account, we're going to pay ourselves back. So I'm going to say we pay ourselves back $500 a month because that's what you would have paid someone else. $500 a month for 60 months, which is what a normal car loan would be to pay yourself back with interest, would be 6 grand for 5 years. So now let's look at this. Let's reflect on this real quick. You put in $70,000 as premium over 7 years. You also put in $30,000 of loan repayments throughout that 7-year period. So $100,000 went in. You also took out 25 to go buy a car. So your net injection into this policy was $75,000. Now look at how much cash value you have access to in that 7th year. $67,881. You had access to 91 cents of every dollar you put into it. And you have a car fully paid for. And you got back 91 cents for the car you bought. Let that sink in. And I'll give you even a deeper example, further example. Well, in 5 years, you're probably going to say, oh, I want a new car, right? So let's show that. Let's show in the 8th year, you take out another loan to go buy another car. And let's say you don't want to pay any more premiums. You don't want to put any more money into your policy. So no more premium deposits. You still have cash value, which you take out 25 to go buy the car. Then what are you going to do again? You all should know now you're going to pay yourself back, just like you would pay back anyone else. You want to be an honest banker with yourself. So $500 a month for the next 60 months. Now let's look at that. Over the next 5 years, you put in $30,000. You also took out 25 to buy a car. So your net injection into this policy was 5 grand. And look at those two numbers I highlighted. From year 7 to 12, your cash value grows from 67 grand to 91 grand. It grows by $23,000 over that 5-year period. And you put in 5. You put in 5 grand, have a car fully paid for in the driveway, and have 23 grand left over. Or if we combine all of this, in the first 7 years, you put in 75 grand. In the next 5 years, you put in 5,000. $80,000 total went into this policy. And look at the cash value. After 12 years, that's $91,000. So you put in 80, you have 2 cars fully paid for, and you still have $91,000 left over. Or you put in 80, you have access to 91, you made 11 grand on buying 2 cars. Because you financed these cars through your own banking system, which is what infinite banking is all about. So there's 3 rules when we're doing this that you have to abide by to make this work for you. One is pay yourself first. This 10 grand a year, he was just saving in a savings account or his IRA. And he thought, well, instead, let me save this in my own personal banking system. Let me save this in my policy, which he did. He paid himself first. This went into his banking system that he controlled instead of anywhere else where he did not have control. Rule number 2, he paid himself back with interest. And rule number 3, he recycled and recaptured that interest. Because if you pay yourself first and you're going to pay yourself with interest, wouldn't you rather pay yourself back that interest than paying someone else? Wouldn't you agree that that money's better off spent back in your pocket than someone else's, right? So if you can do this for a car, what else can you do this for? Everything. Let me show you another example. Let's talk about someone paying off debt. I don't know how many of you guys have debt you're looking to pay off, whether it's just a mortgage and a car note, whether it's a ton of credit cards. Often in America, as you know, the debt rate's really high. I would assume this can apply to a lot of people on here. We had a case where a chiropractor came to us and said, hey, I have these 9 different debts. I make good money, but I have a lot of debt. And as he was making more money with his practice, he started to buy more things and getting into more debt. So I want to make a point real quick. It doesn't matter how much money you make or how little money you make. It's about how much you save and how much you keep. Because this guy was making a lot of money, but he also spent a lot of money on debt. He ended up saving the same amount of money that someone who makes very little money could be saving too. So in this example, we said, okay, well, how can we control our money more efficiently? How can we be able to pay off this debt through our own banking system and transfer it all to our own system? Well, he had a total of $478,000 of debt. He was paying $5,777 a month in debt payments. That's more than most people's income. That's a lot of money he's paying in debt alone. It was going to take him 19 years to pay all this stuff off. So he came to us and said, hey, I actually have about 25 grand a year, around 2 grand a month from my business that I just put aside in an emergency fund that I think we can use to help accelerate this. So we did. We said, great. This first year, let's put in $25,000 into the policy. He then had access in his policy to $14,000. That was how much cash value he had access to, about 60% of his money. He takes this $14,000 out of the policy, pays off the first 2 debts, and a little bit of that Nordstrom card he still has. Now, what's he going to do? He's going to pay himself back. Well, he just freed up $161 a month for his Discover card. He just no longer has this Lowe's credit card either. So he now has $287 a month there that he's able to save too. So if you total that up, it's $448 every month that he's able to save and no longer pay someone else. So he's going to pay himself back, pay his policy back, $448 every single month. Still making his normal monthly payments, still paying these things down, but now he's redirecting where a couple of those payments are going. Now, instead of going to someone else's bank, he's paying himself back. So what's going to happen in the second year? Well, another 25 grand of premium goes in. His cash value grows by 16,000 again. He has access to more cash value than the first year because remember, he was still earning interest and dividends in his policy. So he has access to more in the second year. And repayments. He paid himself back $448 every month, which meant he paid himself back $5,374. So if we combine all of that, in the second year, he had access to about 22 grand total that he could use to pay down his debt, which he does. Pays off the Nordstrom card, pays off the Wells Fargo card, pays off the private loan he had. He just freed up a lot of monthly payments, which he's going to do what with, guys? He's going to repay himself. So now his repayments every month back to himself are $1,900 a month. And now his debt payments are only $3,800 a month. So in this third year, same thing goes down, 25 grand of a premium. His cash value grows by a lot. Look at that. Cash value grows by more than 25 grand because again, he was earning interest and dividends in his policy over the past 2 years. He also repaid himself $1,900 a month, 23 grand. So in this third year now, he has $48,000 in hand to pay down his debt, which again, he does. Pays down those 2 loans, frees up another good chunk of his monthly payments, which he now redirects to paying himself back. And now look at that. He's paying himself a lot each month, which he's just building up his savings account again and preparing for the next year. And he only has a couple payments left. So let's kind of look over this. We talk about this being a marathon, talking about this taking a long time, right? Well, not a long time, but this is you're building the system out for generations to come. That's the point of this whole strategy. It's a long-term wealth building strategy. So over 3 years, how much did he put in? What has happened so far? Well, he put in 25 grand in the first year as premium, 25 and 25. He put in $75,000 as premium into his policy. He also took out loans each and every year, 14 in the first, 16 in the second, and about 25,000 as a loan in the third year. $55,000 of loans he took out. So how much is left in his policy after these 3 years? Some would think $20,000, right? Put in 75, took out 55. No, wrong. He still has his whole 75 sitting in the policy earning interest and dividends. He just leveraged that account by taking a loan from the insurance company against his policy, against his premium. His 75 is growing. He has 55 paying off his debt for him. He's making his money work for him 2 times at once. So let's continue with this example. What happens the following year? Premium, 25 grand. Cash value grows again significantly. He repaid himself $3,600 a month for 12 months. He saved 44 grand there. He now has $70,000 to pay down his condo with, which he does. Condo's not fully paid off, so he has to keep doing this. Does it again. This next year, he has 71 available though. Finishes the condo, has a little bit left on the house. All right, 5 years in, all he has left is a house payment, okay? Now what? Well, he came to us and said, well, I actually have more money I want to put into the system. Now that I understand how it works, I want to do more. And we can't overfund his first policy. Matter of fact, he actually has to put less into his policy after that 5-year period because of certain MEC guidelines and IRS rules that are on his policy. So he came to us and said, okay, well, if I have to, well, I'll tell you, the insurance company said he had to drop his premium from 25 grand a year to 10 grand a year on his first policy to abide by those IRS guidelines. So he said, great, I'll do 10 grand in this first policy now, and I want to set up another policy for another 25 grand a year. So he did, and then his cash value grew. He had access to 13 grand in his first policy because remember now he had 5 years for the policy to grow, so his cash value is growing by more than his premium deposits. He's putting in 10, has access to 13. He made 30% in this policy that year, you could say. He also restarted on a new policy. So 25 went in, he had access to 14 grand again in that policy. So that's a total of $54,000 of repayments he also paid back to himself throughout the year. That's $4,500 a month he's paying back for all those debts he paid off. He's still being an honest banker with himself, still paying himself back every single month. That's 54 grand he accumulated over the year. So all of that cash value combined pays off the home. There he goes. After 6 years, he is debt free. Now, so that example in mind, not everyone has a situation like that. What if you don't have bad debt? What if you don't need a new car? Can you still benefit from doing privatized banking? Can you still become your own banker like these guys have? I mean, that guy paid off his debt in 6 years. It was going to take him 19 years to do it. That guy earlier was going to buy a car for 25 grand, 2 cars, and just spend 25 grand on 2 cars. He was able to recapture all those funds through the system. Now, can you do this for everything? Well, 100% you can. I'm not in a position where I have any bad debt or a new car I need. I'm in real estate personally, like I mentioned earlier. So I'm buying properties through my policy. You can be buying assets, businesses, purchasing things for your family, taxes, anything, all through your system. That's just when the fun begins, is after that debt's paid off. So let's continue on that path of looking at what happens if he kept paying himself back over all those years. Well, his condo was $879 a month, and he still had 251 months left. Same with the house. He was going to pay a total of $493,000 back to the bank over the next 20 months or 200 months. Instead, by using this strategy, he had $493 sitting in his bank account that he paid himself back that he was going to pay someone else. Now, let me ask you, now that you know this, should everyone be doing this? Should everyone know about this? Why don't more people know about this? Well, I believe the answer is yeah, you most likely and probably should be doing this. If you don't do this, you're just going to continue on the same path that you're on right now. And you're stealing from your children or your grandchildren. You're stealing from the next generation because you're not doing this. And that's really what's happening. Not to be rude, it's the truth, because it doesn't matter. If you're making $10 an hour or $10,000 an hour, it doesn't matter. This can work for anybody. I mean, think about it. The wealthy people in America, they do this for a reason, and they do it because, well, they know what it can do for them, and they all understand how to keep money in their families. So if you want to break the bonds of financial slavery that we're all put in, if we don't want to continue to be stuck in debt or continuous cycles of payments and debt and not saving, you're not gonna, well, you have to do things that the 95% of people won't do, because 95% of people will not be financially secure at retirement age. So when you do this, you're setting up not just yourself, but you're taking care of those around you. And this is how I look at it. I mean, do you want to work for your money, or do you want your money to work for you? Like I had that decision to make myself. So when you use infinite banking, like we show you, like I can help you do, like I just showed you people were doing, you're going to make that money go work for you now. If we're constantly trading time for money and not doing anything else, it's a vicious cycle. And it's hard to get ahead. It's hard to actually build any wealth unless we get money to work for us. So again, infinite banking is about control, controlling our money. It's not about anything else. So when it comes to different nuances that come with this strategy, let's talk about a few extra things here. You decide how much money you want to put into the policy. You are in complete control of those premium deposits. And the loans you take from the insurance company are on your terms. The loans are tax-free. You use them how you want. You pay it back how you want. Your policy is always going to grow tax-free, whether you take loans or not. So might as well take loans and start investing in things or purchasing things. The death benefit on your policy is tax-free. I know I didn't talk a lot about the death benefit, but while you're paying down debt, while you're making investments, you do have coverage for your family, which is important. And all the money you put into the policy is safe. It's exempt from any judgments and liens in most states. You can use this policy for all kinds of stuff. You can use it for retirement income, policies for your children, policies for your business to pay for college, anything. Now, let's talk about how to fund your policy. Well, you can fund your policy at whatever frequency you want. You can fund your policy monthly, quarterly, semi-annually, annually. You can deposit it at whatever frequency you want. And it's up to you. You can change that throughout your lifetime as well. And what's the minimum? Some people ask, what's the maximum? Well, I would say the minimum you should do this with is a minimum of 10 times your age per month. The more money you put through this, the better you're going to get out of, the more you're going to get out of this, and the better you're going to be able to do this. So obviously I wouldn't tell you to do the minimum, but if you're in a position where you're just getting by and you want to save as much as possible, I would say try this. Start saving 10 times your age a month. If you're 50, add a zero, $500 a month. And the maximum you're able to save and run through your policy is going to be dependent upon you, your net worth, and your assets. And on top of this regular premium deposit you're doing, you can also do a large lump sum. You could dump, say I was doing $500 a month, and you're like, hey, I also have 20 grand sitting in the bank right now. Can I dump that into the policy, or is that even worth it? Yes, 100%. You'd rather that money sitting in this private bank you control, earning a dividend liquid to you, than sitting in someone else's bank. So yes, you can do some sort of lump sum to start the policy. And you'll have access to 60 to 90% of that total premium deposit in the first 30 days. Immediately, you have access to that money to start using. Now let's talk real quick about policy loans as we wrap up. Policy loans you take are guaranteed. The insurance company can't just say, no, we don't want to give you the loan anymore. They can't just deny you. It is guaranteed in the contract with them. You can take out policy loans whenever you want. And I say policy loans, it could also mean cash value loans or the cash value available. They're all interchangeable words. It's the same thing. And I almost look at the policy loans as like a line of credit. If you go down to the bank and get a line of credit, you'd use that money for something and then you pay it back. Whatever you pay back is available for you to use again. It's liquid. Just like the cash value loans, anything you pay back to the policy is liquid for you to use again. Now, there's no credit checks or approval either. You don't have to do anything when you request a loan from the insurance company. You just say, hey, I want this fund, this money, I want these funds, and they'll send it to you in a couple of days. You ask and you receive it. And these loans are private. So they don't go in your credit report, which is a massive bonus. Because let's think about it. Let's say you want to go get qualified for a HELOC or a mortgage or a car loan, and your debt to income ratio is way too high. Well, why don't you just use the policy, pay off some of your third-party debt, increase your DTI, and now you can qualify for a loan. You just moved all your debts into your own private bank. Now you can qualify for those loans. So the whole goal here is to minimize how much you need to get loans from other people, minimize how much you give to other people, and maximize how much you can save and finance throughout your policy. And this process, again, like I said earlier, takes time. It's a marathon to be able to build a big enough private banking system to finance everything through it. Now, for these loans, there are no minimums or maximums. You can pay yourself back when and how you want. You're in complete control over that. So, for example, if you got a regular car loan at the bank and you missed a couple payments, someone's coming and taking your car. But if you take a loan from yourself and buy the car and pay yourself back, if you miss a payment or two, who cares? You're the one that's in control of that. If you want to repay yourself back more in the future, go for it. So again, if you miss a payment, nothing happens. Now, why should you work with the money multiplier? Why our team? Why me? Well, first off, I'll teach you guys how to implement this strategy completely free of charge. My team and I do not charge anything because we're paid from the insurance companies for the business that we bring them. It's a pretty cool system we have. We're already taken care of. I'm never going to manage your money, invest your funds. You're never going to give me anything. You will do this all on your own with the insurance company and with your policy. We're just a third party to help make sure you build the policy correctly to do this, because you can't just get a regular whole life policy. If you go to your brother-in-law to get a whole life policy, you will not get this. So you have to go through us to get a policy like this, and then we'll help you use it after it's set up. And I've met with over 2,000 families personally all across the country, showing them how to build the strategy out for themselves. And our team, we have a lot of cool things on our team that I love, but we have a lot of unique parts of it. We have specialists for every little thing about this. And we have software that we even developed that no one else has that helps us forecast and manage these policies. We even have dedicated underwriters and some special policies at insurance companies that work just for our clients. And I'm pretty sure that we're the largest producers of infinite banking policies in the entire states. We're the top agency in most insurance companies that offer policies like this. And that's because we have a lot of repeat clients, a lot of referrals, because we treat our clients the right way. We aren't here to just sell you a policy, but to teach you how to become the bank after the policy is set up. And so one more thing I do want to bring up before we finish up. A lot of people come to me, and this gets a lot of attention. They say, hey, can an IUL or a VUL or term insurance be used for infinite banking? Short answer is no. IULs and term insurance policies pay the highest commissions, which is why insurance companies push their agents to sell them. These agents aren't even knowledgeable on what the policy or the product is. IULs and other policies have their purpose. They're not bad. They're just used for different purposes than banking. And if you want to talk about that on a phone call and go in depth about different insurance products, we can. But I just want to throw that in there. Now, to wrap up, only one of two things will happen to us. We're all going to live, and sadly, we're all going to die. Are we better off with or without this? Either way. Well, obviously, I just showed you while you're alive, you are better off with this. You will get out of debt faster. You will pay for cars, boats, homes, and get money back on those things. You can make real estate investments and multiply your returns. Now, what about when you pass away? Well, is your family better off with or without this? Well, if you don't have this, your family's going to get nothing. Maybe just what's in your bank account that's going to go through probate. But if you have a policy, you do have that death benefit. So your family is going to get a tax-free, guaranteed large sum of money paid to them if something were to happen to you. So yes, you and your family are better off with or without this. This is one of my favorite quotes I want to end on. If poor people would just do what rich people do, they wouldn't be poor anymore. Guys, this is so true. Warren Buffett owns a company called Berkshire Hathaway. And guess what company is a part of that? An insurance company. I wonder why he owns that. So today I've talked about the wealthiest families and individuals and corporations and banks that do this. These are the wealthiest people in the country, and they're doing this. So if we, not saying we're all poor here, but if poor people would just do what rich people were doing, they wouldn't be poor anymore. So I want to thank you guys for lending your time to me today, your energy and your focus. This has been awesome. I'm very appreciative of you all. Now, last question for you. Will you guys take radical ownership and action on this? I mean, here's the reality. Some of you guys won't, but most of you should. These two links I have on this screen, the left one is a QR code to book an appointment with me. If you pull out your phone, pull up the camera, scan that link, you will be booked on an automatic phone call with me personally, and we can go through your whole situation and see if this is something you can take advantage of. This right QR code right here, if you pull that up, that's my Instagram. You can see all kinds of stuff I'm doing with real estate, with infinite banking and how I teach it, and just follow me on my journey. But I would appreciate if you guys at least follow me on Instagram to keep learning this strategy. And I know this takes time to really grasp, to really get into. And so if this was your first time being here learning this strategy, I would recommend keep learning. If you set up a call with me, I'll just DM you or text you all kinds of different resources and videos, books, podcasts you can listen to and read to learn the concept more in depth. Because this is just, your first hour of learning about this. It took me, I probably watched 100 of Chris Naugle's videos before I really understood the concept. So I would recommend you guys do the same thing. So I want to open it up real quick. We have about 5-10 minutes left. What questions do you guys have? If you guys have questions you thought of throughout this whole presentation, or you wrote them down, throw it in the chat. I will answer anything you guys have right now with the last 10 minutes or so. And then anything you guys want to talk about or ask personally, we can talk about it on a phone call. So I just got one comment here. Someone saying, and thank you, Dexter, for clarifying and giving your testimony of this. Dexter's been a client of ours for a long time, but he's been crushing it with his policies. So we got a question here about, he said a ULI. You probably meant IUL. Someone said, I just moved the cash value of my ULI policy into a MMP engineered policy to save the cash value and to use it moving forward. This process looks truly valuable and useful. Well, ULI, you probably meant IUL, Indexed Universal Life, and that's what I mentioned a little bit ago. So we can take this conversation any way you want, but those type of products are investments. There's a lot of risk involved. There's no guarantees. The older you get, the higher costs become because you're not locked in. It's usually term insurance that's built into those type of policies. So as you get older, the policy is going to become worse with cash value. And if the market fluctuates, which it always does, your policy is going to have no guarantees and you could lose values year to year. So that's why we use whole life insurance as the policy to do banking, because the whole idea of the policy is to be a asset that is extremely safe, that is guaranteed to grow, that is tax-free to grow, that provides a death benefit, that locks in your insurability and the cost of insurance, so that you now know no matter what, this is going to be here for you forever growing. And then you can always leverage it to make any purchase, any investment that you want throughout your whole life and have no worries about any volatility or any risk. There's zero risk. And if you actually look at returns of IULs, they actually end up doing about the same as a whole life policy. Even though a whole life has a guaranteed smaller rate and an IUL can be whatever with the market, they end up being about the same return. And in a whole life, it's guaranteed. So we can talk about this more in depth on a phone call or Zoom, but that would be my thoughts for you there. Another couple questions here, and then I see you want my QR code again here. I'll throw it in the chat box as well. What was that question there? So are you paying additional premium each month as you're paying your loan back to the policy in order to keep the policy in place? Great question. So the answer is yes. Like in the chiropractor example, he's making a policy premium, 25 grand a year. He's also paying his policy back, whatever the monthly payment was, depending on each year of the loan repayments. But he's, yes, paying his policy back and making premium deposits at the same exact time. All of that money is going through his policy. So yes, you, again, though, do have complete control over those policy loans. So if you don't want to pay the policy back, or you want to miss some time of paying yourself back, you can totally do that and pay yourself back more in the future, or never pay yourself back. Because if you don't, it's just going to be deducted from your death benefit on the day of your passing. So if your death benefit's $1 million, you've taken out $100,000 of loans throughout your lifetime, your family is just going to get 900 grand. So if you never pay your policy back, which you can do, it'll just be deducted from your death benefit. So you're leveraging your future self while you're financing things today. Norma Valdez, yes, this is a whole life policy. We are teaching people how to use whole life insurance as a financing vehicle. It's not normal whole life insurance. You can't just go down to your local agent at State Farm and get something like this. And Louis, you said again, after I understand the risk, I had to find a way to preserve my prior investment. The engineered whole life policy is the answer. I 100% agree. If you're looking for a place to store funds and bank with it and invest through the policy, I mean, a whole life is a much better policy. So we can talk about that one-on-one. We can look at your policy you have now, see if we can do some sort of 1035 exchange, roll it over, or if we need to lapse it and start something new. I don't know the situation. We'd have to look at it all. But you're probably right. You probably should exchange or change where those funds are at. And last little disclaimer here, go back to your guys' CPAs and your accountants, CPAs and financial advisors, and ask them if they've heard of this concept. I bet you they haven't, or they'll say, oh yeah, I have, and they'll sell you an IUL or term insurance or something. They won't know really what it is. So I actually challenge you guys to go ask people about this. Go talk to your peers, see who's heard about the concept, because it's interesting. A lot of people haven't, or they they're in the financial industry, but they don't really know the concept well. That's why people like us, this is our niche. This is all we do. You have to go to someone like us to do something like this. And last couple questions here. I believe I understand your heirs get the death benefit and not the cash value, right? But the death benefit will be more than your cash value, right? 100%. That's correct. So let's say you're putting 10 grand a year premium every single year. After what, 30 years, you've put in a lot of money, $90,000, and or it's $30,000. No, whatever that number is, 300,000. And your cash value is 500,000. Well, your death benefit might be $1 million. Every time you make a premium deposit, your cash value grows and your death benefit grows. So they're all going to parallelly grow. They're never going to be larger than the death benefit. Last question, if a premium payment is missed or is not the agreed amount, what happens? So great question. If you have a premium 10 grand a year and you can't fund it, what happens? So there's a minimum of that 10 grand, maybe 4 grand or 3 grand is actually required to keep the policy going. And if you don't fund it yourself, the policy will use this cash value that you have in your policy to just pay the premium for you. So it can do that for a few years if you have enough cash value, and you don't have to keep funding the premium. But eventually, if you had no cash value, you had no money to fund the premium, you would have nothing there left and you would lose the policy. So you want to make sure that premium is something you can do, or at least the minimum something you always can do to keep the policy going. So anyway, throwing my calendar link in here again. If you want to schedule a phone call just to hear about what this could mean for you, or if you want just more resources, there you go. Book this time and slot to meet with me, and we can go through it. And then, yeah, I think our team will be here again every Tuesday talking about the same strategy. Every week, actually, we do webinars about all kinds of different money strategies with real estate, investing, lending, and all through their policies. So it's pretty cool. I thank you guys for all being here, and I hope you guys have a great rest of your guys' week.